Now, ECB officials are set to cut interest rates next week, with inflation on track to reach the 2% in the coming months. Well, joining us now is José Escriva, the governor of the Bank of Spain. Governor, thank you so much for joining us. I think this is our first interview together because you joined the Banco de España 4 months ago. So congratulations on the job. I mean, it's going to be quite volatile and difficult. You have, of course, an ECB meeting next week. Is an interest rate cut a done deal?
Well, we have to. The meeting itself is relevant. The discussions in the Council will be actually very relevant, and we spent actually 2 days there discussing a wide variety of issues, indicators, inputs provided by the staff. So it's. I would not pre-commit to a decision, but certainly I would say the market expect a further cut of 25%. Seems to me that this is the most likely scenario, but I don't see any reason at the same time to. My personal view is that's fine. I mean, to continue with our gradual approach to normalization of monetary conditions in the euro area.
Governor, how do you see the stickiness of inflation? What do you worry about that you're not able in this last mile to get down? And this is even before possible tariffs from Donald Trump.
Yes, I think this is primarily confined to service inflation. And it's true, and we are making research on that. The expectation is that service inflation that at present is hovering around 4% should decline over the next six months around 3%. I mean, there are good reasons to believe that this is going to be the case because wage pressure are diminishing and forward-looking indicators of wages are pointing in that direction. But, of course, we need to wait until this expectation, this forecast is materializing.
Yeah. When are you expecting that to materialize?
I would say that over the course of this year, actually already 2025, and the incoming data will be relevant. I mean, when we say that we are data-dependent, I mean, this is, in our communication, this is really so. I mean, in a situation of uncertainty, with some issues to be clarified, we need to wait for hard data to confirm our forecast.
Yes, it's not that easy because it's hard data, but you also have to look at expectations to make sure that you don't go too hard or one way or the other.
Precisely. Right. But I would say that in a situation of particularly high uncertainty, hard data, incoming information, meeting after meeting, proves to be more important.
But because it doesn't behave the way that you think it should? I mean, for example, what does it take for Europeans to start consuming properly?
No, let me tell you something. At the same time, there is high uncertainty. The reality is that even if you look from June up to now, but more specifically, since the last meeting of the Council, basically the information we are gathering is confirming our central scenario. So there is a lot of uncertainty, two-sided, but at the same time, the incoming information is confirming the central scenario, which is one of gradual converging of inflation to 2% and of a recovery, which is not particularly impressive, but a slow recovery of the EU economy as a whole. It's true that there are some downside risks to growth, and this particularly stems from weak domestic demand, not only consumption, but I would say more problematically investment.
But Governor, I mean, internationally, we don't really know what happens between the U.S. and China, and Europe could be at the forefront, right, of these pressures.
Yes, I mean that's one of the sources of heightened uncertainty, stemming from geopolitical risk, but also from, let's say, what the U.S. administration is going to ultimately do in a number of areas. I mean, we have made a lot of simulations internally about impacts, might be potentially very impactful. I would say that on growth, I mean, the policies that are announced are not particularly growth enhancing, not only for Europe or for the rest of the world, but even for the US, if we take a long-term perspective, doesn't look like. I mean, and at the same time, I mean, the policies can be potentially inflationary in the US. Yes. It's less clear whether there's going to be spillovers to the rest of the world, but this is something which requires careful monitoring over time.
But does it mean, Governor, that through your modelling, you're also able to say, for example, look, if there's 15-20% tariffs on Europe, or if there's inflation going up by, let's say, 0.5% in the US, that means that our interest rates will have to do this. Is that possible at this point in time?
First, the most difficult thing to calibrate is even the impact of tariffs, because it depends very much on the reaction of third countries, which are very, very difficult to predict. So the first source of uncertainty stems from what the Trump administration ultimately is going to do. But then the reaction of the others, I mean, and the impact on the economy, I mean, the instruments that we have, since this is not something that happens so frequently, I would say are not sufficiently reliable. Or I would say that we have to operate, unfortunately, with a high uncertainty.
Right.
But this is what we do all the time, central bankers, to deal with uncertainty in a way or another.
But so does it also mean that the ECB is maybe a little bit more sensitive to what happens with the Fed and interest rates there, interest rate expectations?
I mean, I would say that to the extent that it impacts us to different channels. I mean, the exchange rate channel is one of them. But, of course, we need always to factor in all these elements within our framework. Yeah. I would say that uncertainty is high, I mean, no doubt. And that's the reason why our data-dependent optionality, full optionality, is to retain this full optionality is more important than ever at the present juncture.
Governor, thank you so much, as always. That is José Luis Escriva, Governor of the Bank of Spain, giving us a little bit of his busy schedule for his first interview, actually, on Bloomberg. Coming up, the U.S. targets Novo Nordisk's blockbuster diabetes and weight